Good morning, everyone. It says you are live, so I assume I am. And let me talk a little bit about this setup, where we are, and what I think might be happening. The first thing I want to mention is we're heading into a week where we might see a bit of a change of character. We had options expiration on Friday. So that kind of lets volatility expand. There's less gamma just by virtue of the fact that all those big positions that were nearby in time are gone. So that allows us to unclench a little bit. We have VIX expiration on Wednesday, which I've been talking about for weeks, and that allows VIX to kind of move around a little bit too. Additionally, and I'll show you the chart a little later, um, I noticed VVIX was perking up last week, the volatility. So as we were making new highs, VVIX was perking up a little bit. Um, TDEX, the nation's index demand for tail hedges, was perking up a little bit. Nothing crazy, it's perking up a little bit. SPX, which is like the one standard deviation out. So we notice, I'm noticing just a little bit of something in the volatility space, and it won't take a lot to upset the apple cart. It won't take a lot to upset the apple cart. Now, another thing, remember we had in the end of June all those systematic buys from CTA funds and vol control funds and all that. Well, those flows are basically gone. So we don't have those flows at our back. If anything, tiny buying on an up tape, but more selling on a down tape. All of that leaves us vulnerable. Not saying we're going to crash, not saying anything. If something happens, it could be 1, 2, 3%, not a big deal, or more. I don't know. Your crystal ball is as good as mine. What I am saying is this is a time to be somewhat cautious. So we have VIX options expiration, FOMC minutes on Wednesday, which I'm thinking will be a nothing burger. We have Jackson Hole when Powell takes the stage. And then the question is, in my mind, how does he spin it? We had the weak jobs report, yay, rate cut 50 basis points. We had the CPI on Tuesday, I think it was the CPI, good enough, that's when the market broke out. Then we had the PPI on Thursday, no good, inflation is back. And so what part of the narrative does he stress, if any? The other thing is, of course, there's the old fallback of data dependent because we have non-farm payrolls, and whatever one's GDP. We have a couple more numbers before the FOMC, so he can just kick the can down the road, data dependent. And the other thing that, hi, Valtrader. Valtrader, if you want to get on the stage and speak, I'm going to put you there. If you want to speak, you can. Welcome, buddy. Let me finish my little spiel here. And we have, so we have those data points coming up. So that's sort of the landscape coming into September, seasonally weak. Once the August end of month options expiration clears away. Oh, we also have NVIDIA August 27th. And so there's a lot going on. I'm not saying today we break. I'm saying I'm cautious. And if I'm cautious, then you should definitely be cautious because I'm kind of in the perma bull camp. I always see the glass as 90% full. Now I only see it as 75% full. Okay, so that said, let me kind of go through the paces here real quick because it's the beginning of the week. Okay, so this is the weekly expected move. 63.50, was that 63, 65.36 ish on top, 35. I like to mentally round it off to 50 on top, give it a little room if I'm selling spreads, and 64 on bottom. So a relatively tight range. Considering what's going on, I think the range is a little tight. Or if anything, if we stay within the range, we could bounce between both sides of it pretty much. Okay, so what else do we have? Oh, yeah, then we have earnings. We have read-through type earnings. You know, we have Home Depot and we have Walmart and we have Palo Alto Networks, so Target. So we have things that if the market wants to take out its crystal ball, it could read into the economy that could be a positive or a negative. Depends on what the algos think. Doesn't depend on what you or I think. Okay, now let's get to the main event here. Let's get to where we are and what the day looks like. Okay, so you know, I'm just looking at my notes. Volatility, we know that. Okay, so if I'm looking at this 50 kind of as our inflection point magnet to the upside, we're probably what 40-ish now. Oh, 47. We're almost there. Okay, very good. Gives us a nice clean setup. So we have market maker. Good morning, Selena. So we have market maker negative gamma here. And so this becomes our magnet to the upside, and we're there. But then right on top of us, we have market maker short, long gamma, which is a stall. So we have this little go up. If we get over it, stall right here, come right back down to this magnet at 50. And we have this supportive feature down here, 40, 35, whatever, to send it back up. So we have this fly looking structure that kind of wants to keep us in the middle here for now, for the open. Good morning, Jason. And that's kind of the close to the money stuff. Looks like I posted the wrong thing here. Let me look. Whatever. That's okay. Um, to the upside, let's just look at the difference. So the chop zone, kind of make it what you want, 70 on top and 30 on bottom, you know, somewhere down here, this area here. We got the back and forth over here at 60, 65, 70. That could be an upside target, an upside fly. Or we have, if we can get some kind of news to get us moving, 70, 75, 80. So this whole top part over 60 is kind of back and forth, back and forth. Now, we also have this big bar, I think everybody sees it, at 6,500. What does that mean? Market makers are short calls, customers are long calls, bigly up here. Right now, that's got very little influence. That's What's the delta on that? That's a 2 delta. Howdy. That's a 2 delta. So it's basically a nothing burger. The other way to look at it, though, is they don't have many long futures here to hedge this. So should we go up, say, 10 points, I'm just going to eyeball it and say that it becomes maybe a 10, 15 delta. And if it starts to become a 15 delta, then it starts to matter because of its size. So, not saying we go there. We have plenty of stuff to stall along the way. I'm just saying that's something to keep an eye on. While I'm here, I know I'm switching gears, but where would I place the fly? That looks reasonable. Set to 70. That looks reasonable. Or we could place an upside lotto for 60 cents. Or downside, let's look at what we got on the downside again. Downside, we have 30. We have this. We have 30, and this big magnet down here is 6,400. So if 30 breaks, there's not a lot to stop us from pulling down towards 6,400. So 30 is the one that has to break or hold. So let's just say that that'll stall there. Now, if I look at a 40, 30, 20, a buck 25. So I don't want to spend that much. I'm cheap. That's a buck. All right. So not give anything away, huh? I'm always down for a cheap 5 wide. Iron Condorsville. Well, let's just talk about how I think about an iron condor. I wanna. I like to sell wide, not investment advice. So if I could be below this support, good morning, Sherman. And I don't like this magnet. So if I can get below here to 90, where we should bounce probably before that, and again, that's way outside the expected move. So 85, 65 is 45 cents. That sounds good. If I wanted to sell tighter, maybe something like that, 0540 or even 1005 for 50 cents. That's not bad either. I'll put one of those in. On top, at this stage of the game, I don't see anything that I like. I just don't. Maybe 85, 05 for 45, sure, one for fun to balance out the put. So I don't see anything great on top for now. That's basically what I'm seeing. Go ahead, Vol Trader, speak. Where'd he go? And now let's change views here. Oh, and I have another toy, but I'll show that maybe tomorrow once I get used to working it with it. And here's a table view. I just find this real easy to look at. You can see where the numbers are, nice and bright. Let me make it bigger. Hopefully, on YouTube and Twitter, you can read the numbers. There he is. Go ahead, Val. You want to say something?
Can you hear me?
Yes, I can.
Oh, okay. So, yeah, hi.
Hi. This is my buddy Val Trader. We trade side by side. Haven't in a while since I've been doing the Substack, but he knows his shit. So go ahead.
Okay. Today we happen to see exactly the same levels and pretty much the same thing. But I can go over a couple of stuff you didn't mention.
Okay. Do you
And
want you want to share your screen? You know how to do that? Do you want me to let you share screen, or you just
yeah,
want to
yeah,
do it
let
verbally?
me share a screen. I'll figure it out.
Okay. Let me. How do I let me? How do I do this again? Okay, I'm stopping sharing, and now you can do present or invite. Let me see. So then you see where it says present or on the
Yeah, yeah,
bottom.
yeah. I'll try to.
Yeah. So now you can do it because before I was on there, so you couldn't do it.
Okay, 1 second.
And while he's getting that together, oh, I can't point to this, can I? Oh, Punklandia is here. Oh, we have the whole crew here, the ganze Mishpucha.
Do you see my screen now?
Let me put it up there. Yep.
Okay. So, software-wise, I've been using multi-charts, which most people don't know, but they invented something called TradingView. And then all the focus went to TradingView. So they're the owners of TradingView, this Russian company that spun off TradeStation 20 years ago. So 25 years, 20 years. I'm still using their old tool, and very flexible tool, connects to anything and everything. I do my own stuff on with Excel spreadsheets and some Python, analyzing options and stuff like that. I can show you guys for a second. Let's see if I can share this. 1 second. Yeah. So I have this type of things in the background that feed that multi-charts. So some models about the distribution that I think might happen. Right. So, for example, today, potential range is 64.35 on the ES up to, what is it, 65.05 or so. Um, and some skew analysis down here and other stuff. So I have all types of calculations that I use and combine them somehow and feed them into the multi-charts that you guys are seeing here right now. And so I have the various distribution levels on this right chart here. Um, so the blue, the green, the red, and the cyan, those show the potential distribution of the price, up or down, regardless of the specific levels. These are basically, let's call them averaged out of the various options for the week, and they represent what I think the most realistic levels that the market can meet at any given time. They move with the market, but are very spaced out. So I try to have them stable as much as possible, because otherwise it's just another line that would move with the price, and it doesn't have has no meaning. What I do with the skew and implied volatility, I look at where the market concentrates in terms of trading and volume. It could be, obviously, the zero DT has the largest influence, but the least amount of information, if you ask me, from a swing perspective. So I'd rather find 1 plus DTE up to Friday and try to pick from those where some activity, some information is trading, and then look at those implied volatilities and distribution options through those expirations,
And
He's
you're going to
talking
do
here.
that. You're going to do that for a swing trade.
Yes and no. First of all, my bread and butter is I day trade. So I day trade options and futures mostly. I do stocks also, but I do them I do them a lot now because the market is dead, right? The volatility is so low. Every day you see the VIX at 10, it means that the price will not really move too much, right? That's what it means on a daily basis. So it goes down to 8 sometimes. So you cannot expect to have enough swings. I trade the ES and the NQ, but when vol is low, then it's low, right? The daily range will be low.
Let me
And
explain. Let me explain something to them. Now, when you look at VIX and you see 1514, he's talking about the realized vol. If you look at the actual vol, it's like a 10 or an 8. So we're looking at. I guess so a lot of people aren't aware that that's what we're talking about.
yeah, so first of all, I never look at VIX, but for the sake of the conversation, both VIX or anything other, any other index, whether it's volley of nation indexes, which I think is much more representative of what's going on in volatility, but any one of us can use TOS or IB or whatever you guys use and extract the add the money implied volatility from those options. So let's say you look at the next 5 days up to Friday, and you look at each one of those at the money vols, and you weighted average them. So let's say the zero DTE shows 22. I would recommend not to use the zero DTE at all. So +1, +2, +3 DTE. Let's say they show 16, 15, and 14, right? Something like that. So you can average them and weight them based on the DTE or based on whatever you want. You get some type of indication of what is the implied volatility that is currently being priced in the options, right? When you look at an option screen, you're basically seeing automated machines of market makers that are quoting consistently and throughout the day any given option that they make market from. So that information is how they perceive the potential move um, from a distribution point of view, right? So if you take the implied volatility and you divide it by whatever 15.8, 16, you get the potential day, the expected move. That is a rough estimation. It's very not accurate, by the way, but it's a good starting point. So what you want to see is the dynamics between from day to day, right? So if yesterday was, let's say today is 15 and tomorrow it will be 22 and the market didn't move much yet, it means that the market makers are expecting some news or some type of information to hit the market, and then and they expect that the daily range will be much wider than the previous day. So that is good information. For example, if you can guesstimate whether the move will be up or down, so you can position yourself accordingly. Okay. Now, generally, it's not that easy, but it is there. Everyone should remember the only asset that carries forward-looking information, the only asset that carries forward-looking information is options. Any other thing is looking in the backward mirror, right? It's already done. It's already priced. But options are a betting machine or a guessing machine towards what's going to happen. So
Remember,
yeah,
what goes into the options price for the folks that are listening is the expected move over time. Technically, the standard deviation of the expected move over time is what goes into the Vega calculation. And so that is, as he said, really the only actual forward looking pricing tool we have. As clumsy as it may be, we have nothing else to go by.
true, true. That's the only thing. Unless you're super sophisticated and have enough money to get some really specific data feeds, um, the options and the tools available today, whether it's what Doc shows, I don't know what that was, option depth or whatever, or spot gamma, or all those are amazing tools. Like going back 15 years, if you couldn't develop those for yourself, they were non-existent. And today it's really widely and abundant and available. So really good stuff. Now, what I try to do is use that information and try to understand what's going on. So if you focus at the lower two panes, and specifically the second from the bottom, that white, I'll change it to another color so it'll be more easily seen. Let's see.
Yeah, that looks like TradeStation, the way you change the colors and stuff.
Yeah, I said at the beginning that's what I used.
Yeah.
So I'll change that into cyan and make it a bit more wide. Right. So that thing. Okay, just a second. I'll be back in a couple of minutes. I have a phone I need to pick up.
Okay, so I'm gonna take you off, and I'm gonna babble. Okay. Now this is a new toy tool that I'm checking out from somebody. I really can't say anything about it. It's the first time I'm looking at it. I'm really not even sure what the levels are, but I know that this is some kind of expected range here, 6,500 and whatever this is on the bottom, almost 6,400. And I'm going to check it out. I'm going to play with it, and we'll see if there's a pony there. And it's got other features too, but just let's get back to what I'm used to using. I'm saying that, I guess, to say this. I'm always looking to up my game. And if I have one tool that maybe I'll use one time in the day or in the week, whatever, it's worth it for me, A, for my own pocketbook and also for everybody else's. I mean, you know, uh, people subscribe to what I say. I want to make sure I give them the best information that I can. Okay, so now you see we're kind of perking up a little bit, trying to go to that 6450 magnet, like I said. And while we do have some unclenched, it's still the market's supportive, but would be the best way to characterize it. Supportive, but stall right here at 60. So this looks like, whether it is or not, I can think of it as a 60-65 debit spread. That's kind of where we would head should we break through here. There's nothing stopping us really at 55. Well, this looks like a fly, 60, 65, 70. In here, the red in the middle is about the same exact size as the green over here. So these kind of fight with each other, so to speak. To the downside, though, below 50, there's really no sizable number here, 1,000 contracts or more till 64.30. But it's market makers short and long, rather. So this whole cluster would be supportive. So it might not get to 30. Good morning. It might not get to 30. It might get to 35, whatever. I think 37 was the overnight low. So, right here is the first downside test, and you want to see that hold. Otherwise, you have a little bit more here at 25.20 round number. Then you start getting into the territory where market makers are short gamma. I don't like to say we are in positive gamma or negative gamma. We have negative and positive gamma. And yes, overall market makers are still long gamma. Trust your eyes, you see green. But there was also short gamma down here. Locally, if we get there, then suddenly they're short gamma. So I think we do ourselves, retail, a disservice to think that we're in somewhere, although there is something to saying we're in a regime. But anyway, uh, he's disconnected. I got my boy Punk over here. You want to say a word or two? I'm putting the band back together for you guys this morning. He's not here. Okay. The schluft. Okay. And we have Zelensky, who's here for a meeting with Trump, but he thought he would stop by to say hello. What do you want to tell the good folk? Did you put a suit on at least?
I can't talk. Can you hear me?
Okay. Yeah, I can hear you.
Oh, yes, yes. I hopefully this time I won't get verbally assaulted by the vice president and the president all at the same time. We'll see what happens.
Okay. Well, good luck. And straighten your tie. You look like a schlump.
Exactly. I'm wearing schmatas in the Oval Office.
You will. Okay. So anyway, that's what's going on here. Let's take a quick look at market maker exposure. Let's look at charm. And the teacher in me wants to say, okay, you should have ideas where we're going to pin, because we looked at the structure right here. We talked about a few fly-looking structures right here. So let's see how it looks on the charm chart. I used to teach graduate students. So right here, that same 55 area, right between these, kind of 80 is the furthest, so a 75 pin if we get bulled up. Remember, the all-time high intraday was 81. So what's the excuse to make a new all-time high? I don't know. A deal with Zelensky? I don't know. 50, nice round number, good place to stop. If we have a little weakness, then down here in the 30, 25, if we look at a chart real quick, on my thing, I give you levels and lines. I talk about it. Where was it? I think so here was the overnight high. And if we look at last week, the 6,400 was last week on Tuesday that we broke out from. After we broke out from that 6,400 on Tuesday with the CPI, this 30 area was as low as we went. So we were in this tight range with the upward bias. And so, not by coincidence, I think, we have this here at 30. We have this support, we'll call it, at 30. And so that's kind of the lay of the land today. I got something in private chat. Oh, he's back. Okay. I'm going to put, okay, Zelensky. I'm putting Vol Trader back.
Whoa, Zelensky is with us?
Yeah, Zelensky's here.
Oh,
He stopped. He has to make a few trades before he goes into. Now, you got to watch him. If he buys puts, you know he's going to tank the talks.
That's right.
Yeah. I would like to be a fly there in that room where the European Zelensky and Trump are sitting. That would be good. Anyways, back to my stuff. So
let me take my Drek off the screen. Go ahead.
After doing some analysis, right? So
yeah, tell the folks at home where we're going to go and how to make some money.
Yeah. So so the process is similar to what Doc does. Doc does it excellent, right? I'm not super accurate on the levels and stuff. I just want the main levels. So this is my own way of analyzing the open interest in the Greeks. That thing that you're seeing there. It gives me an idea of where sentiment changes, basically where the red goes from positive to negative. So around, I'd say 64.30.
There you go.
Yeah, is where stuff can potentially get more negative on the SPX. I do this also for the Qs and for the SPY. Now, well, you would imagine that the SPY, SPX, and ES is basically the same asset, and it is. they have a different structure with the open interest, and obviously the Greeks look a bit different. I find the SPY very informative. The ES less so. Very little open interest there compared to these two, to the SPX and SPY. Now, I'm not saying that the SPY is better than the SPX or vice versa. It doesn't matter. Everyone has his own beliefs and should stick to them. But I do watch all, as much information as I can. So I go through the NQ and do that process, and go through the QQQ and do that process. NDX, there's no reason to do it. It has a different meaning. But on the SPX, I go through the SPX, the SPY, and the ES, and I try to see confluence and maybe some hints on something that is camouflaged within that mess. Anyways, so if I assume that 6430 is where things can change, and we need to understand the market is bullish, of course, right? It's getting more and more bubbly, and it can do so for the whole remaining of the year. It's not enough to just break through some level. You need either some news to support that, flows to support that, right? And while we had the last 3 days where pure selling, it didn't really affect the market. It was more like profit trading rather than profit taking, rather than really pushing the market lower. It seems that if you push it lower enough every day, you get dip buyers. That's the dynamic that is currently here. So the expectation to the downside is accordingly. And furthermore, if we look at the total picture, right? So the gamma flips around 6,400. Now, while this is looking at all the options in August, it does have a meaning. It does have a meaning, not only because of the dynamics that change when the market goes negative gamma or positive gamma, but it's basically, I think, a test of the nerves in this market. So the market is very bullish. It doesn't expect any downside, right? So if it goes through the gamma flip and suddenly the market makers change the dynamics of the way they hedge, that can catch the market off guard nowadays.
Now,
Yeah.
real quick on that. Where does the curve? The curve is bottoming out and topping out around what level it is? Because I can't see.
Yeah, 64.50. Well, on the green is the 0 DT, so
Right.
64.
So give us the zero and give us the longer term.
Sorry, the 0 DT tops out 6,500, and bottoms out around 6,300. So not really relevant. It's pretty obvious and pretty far, right? And it's way over the expected moves.
Right.
No matter how you calculate them, but the gamma flip is a robust and robust and very deterministic level, pretty much around the 6,400. And furthermore, I don't know who's following this, but it has been so for the last 30 days, right? Or for the last 20 days. So that level is already really rooted in the expectations, in the complacency, in the structure of the options and how they roll them. They see the 6,400 as some type of an important level, and they will be confident above that, and they will probably react if that were to break, especially if some type of news. Now, the market is very bullish, so the only way it can really go down is if some information that is totally not priced in the market will hit the tape and will catch everybody off guard. I don't know which kind of information that would be. And, it won't come from Zelensky and stuff like that, even if today we might have some gyration of the market.
It'll come from Powell if it comes from anywhere.
Maybe. I think that, yeah, it could be, obviously.
If it comes from anywhere, I mean, that's the obvious, next catalyst,
What I'm trying to say is to really move the market down and create some downtrend over a couple of days, not like intraday, right? You really need something that was least expected, or was really priced at the edges, right, with low odds and stuff like that, or something that is totally not even perceived or thought about. So because we don't know that, we don't care about that. What we have in front of us is a trending up market, very strong on the daily market, on the daily chart. And as long as those levels hold, they hold. That's it. So in positive gamma, we have a tendency for mean reverting. So the market goes down, it goes back up 20 points, it goes up, it goes back down 20 points, so on and so forth. And this waiting pattern, obviously, because of the Russian U.S. Thing with Ukraine. So now that is capturing the attention, and soon we'll have some earnings that will capture the attention. But for now, we're there. So when I look at the information in front of me, I try to convert that into some actionable trading. So for me, it's pretty clear that 63.30 and under, my tendency will be short. Regardless of my background positions, that will mean that I will either be short the futures or flat. I won't be long. And above 30.40, I will either be long or flat. I won't be short. That's how pretty much I see the market dynamics. Now, to try and remain objective, what I do is, if you look at the Cyan, the second pane from the bottom, those last two panes coming off the Excels that I run give me a way to compare either the bullishness, the complacency, the bearishness of the market towards where we are. So let's say I've been trading 64.50 SPX for several days, right? And one day these indicators show one thing, and the other day they show another thing, right? If we break a level, let's say 64.30 today, which we deem as important, I would expect the market to be less comfortable, a bit more bearish. I would expect the Cyan to go up. The Cyan is just is basically the tail, the tail divided by the at the money IV. So you take the tail IV, however you calculate that, you divide it by the call tail, deducted by the call tail, and then you divide that by the at the money. And you get this index, which is pretty robust and will move anywhere between 1 and 6.
So it's basically like your version of a skew index.
Yeah, it's very common. Just a gauge, a fast way to say, okay, I'm at the same level like Friday, but this gauge is higher. So the market is a bit more anxious, right? Now, it doesn't mean it will fall 50 points, no. But if Friday they were completely complacent about the level, today they're not, right? And obviously you would say, yeah, it's because of that Zelensky, US, whatever, right? The people tend to slap on the market some news and say that's why, whatever. And that might be true or not, I don't care.
I don't care either, right?
The higher these go, these two indicators, the bottom indicators go, the more anxious the market is. And then my expectations and greediness towards the trade is higher. So if we were to start trading lower, 64.30 and under, and that Cyan would go up to 4, I would then say, okay, let's aim for that short future position all the way down to 6,400, because the market is pretty scared and they're already front running with increasing volatility even before we hit 6,400. So I would be more greedy. And vice versa, if we go up above 64.50 and this would drop to 1, it means that everybody's long, just long, that's it. So it could go up 10 points, 20, 30, whatever. It can go based on the levels that you provide. One could tag to each trade some profit target that would be realistic and not too greedy, but on the other hand not too you want to stay in the trade as much as you can, because the moves are so small. If you miss 20 points here, that's it. That's all you get. Yeah. So that's the way I blend things together, and basically I let the market decide for me how to manage the position, when to enter it, and what to expect of it. Right. That's pretty much what I look for. Now, the last 30 days are more of the same. So regardless if the market is going up 0.25% every day or not, the dynamics are total complacency, right? Which everybody would see or assume or grasp from how the VIX is very low, right? And this is the dynamic. So I mean, this represents everybody in the market. So, and very smart people also, right? These market makers and other houses that do this. And if they are pretty complacent about the market, then I feel, you know, I feel I can be the same. So unless this changes, any down move, I would expect the market to be bought. So buy the dip and stuff like that. And any up move can be, you know, should be very small because of the IV, but can drag all day, right? It can just grind 20 points over 4 hours or 40 points over 4 hours.
The fly in the ointment is VIX expiration.
Which is Wednesday. When is
it? Wednesday. Yeah.
Yeah. I too much to say about those expirations and what to expect following an expiration. That might be so, might be not. You know, Valsig would be probably someone that knows that. But yeah, it could be, but I'm trying to trade whatever is in front of me right now.
Right. Well, this is going to be in front of us in a day, in 2 days. So if you look at the chart here, I like to, I guess, use the gamma edge one. I like the way they lay it out. 16, we have 277, whatever, almost 300,000 puts. So basically, the VIX is buried under these puts. And in the overnight session, we got to around 1590-ish, and then we kind of stalled out. So once these puts go away, once this stuff that's suppressing vol goes away, and so it's gone. And I think this is the...
So go to the 27. Go to the 27 for a second.
Oh, 27 is not going to be enough volume, but you can see the calls are right there.
Yeah, I see it completely changes, so it's only upside.
Yeah. Right. Yeah. So, and if we go to the next monthly, to the September, okay, there's still some puts here, but now 17. You know, but if we just look at the open interest and forget the colors of the bars, because the colors of the bars are the gamma, and it's far away, so it doesn't have a lot of gamma. But if we look at the numbers, we have 139,000 at 20. That's where everybody's taking their bets. If you watch the volume like I do, you keep on seeing 2025, 2022 debit spreads or flies or calendars, you know, like... I don't think all of these are long. You know, you see a lot of flies and calendars and ratios and funny structures coming in. And you also will see like big positions coming in at 60 or at 35. I know 60 is what SVOL likes to use as their hedge. People that are short vol in these, you know, like ETFs or systematic hedge funds like to use like a 60 vol. You know, they'll buy these calls that are basically going to be worthless as insurance. So, but the action is right here, 20 to 25. And if we can get over 16, 17 after expiration, then there's a path up toward 20.
Does this match the chart? Could you show the chart of the VIX? Does this match the chart of the VIX, the price chart?
Does this match the price chart? Let me pull up a price chart.
Yeah, because I'm curious to see if they just splatter the technicals on it, or if you see. That's pretty strange, because I mean that's complacency. They are hedging 19 and above. What about 16, 17, 18? Right? I mean, are they gonna stay like unconcerned all the way up? I doubt
Buy insurance when you can, not when you must. You know how it is. They always chase it. Vol goes from 18 to 20 to 22 to higher.
Yeah.
After the fact.
But I think the complacency is really shines here, because you're so close to 6,400, right? The volatility will spike if we go through 6,400, and they don't even start, they won't start chasing it before 19. So that just
Now,
shows the market
yeah,
is very bullish. Yeah.
now where you see it though, considering where we are, VVIX is at 98. It should, quote unquote, be below 90. Considering where we are, and considering the way we've been acting, it should be down here. So you
Yeah.
see it a little bit in VVIX. You see it a little bit. You like it too in TDEX, Nations Index. A little bit of buying of tails. You see it a little bit in SDEX, the one standard deviation skew. So you're seeing it a little bit. People are starting to nibble, and that adds potential instability should something happen and we begin to break 64, 63.50. Then that opens the door for this stuff to realize, and that's when we can have something that really we shouldn't have, quote unquote, just because of the thin positioning there.
Yeah. Now, important to understand. Let me share. Let me share something for a
Go ahead.
second.
Yeah, let me get off and go ahead. And then I'm going to have to run. We'll listen to Vol 6. Whoops, hold on. Let me put you back on.
This will take 1 minute
Go
here.
ahead. Go ahead. Go ahead.
So if you see in the middle of the Excel, you see this gray chart. This shows the options are basically representative of the future, right? So the options on the ES are the synthetic future. And what I track in one of those charts that we saw before is the spread of the implied future. If you were to go long the future through the options or short the futures through the options, you can see the implied bid ask here. These two cells show you the implied bid ask over the actual future. We know the future trades quarter points. So look at this. They barely make money on this, right? The spread is so tight. It's 0.4, just above, right? Just above the quarter point that you would otherwise find in the actual future. So, I mean, the liquidity is so high, complacency is so high now that they barely make money off the spread of the bid ask of the options, right? Even though we might say, yeah, that's 1 point or half a point, and they make money, but now the perceived risk is so low that they're super aggressive and trying to compete to get any business, right? So they go down with the spread to quarter point almost. Now this can go up to 2, right? When there's volatility, this bid ask would be 2 points. That means that if you go buy the ES, you have a quarter point spread, but if you trade the options, you have 2 point spread, so 8 times higher.
And so
But
now,
right now,
at what number spread would you start to say, that means something?
above
75 cents, a
one.
dollar?
No, most of the time it trades between 1 and half a point. So that will be like 80% of the time. So above 1 means there's a bit of anxiousness in the market, and above 1.5, you already feel and see the expected move increase and the intraday volatility increase. So you don't even need to look at this. I could just look at the price action and tell you right now, I can guess it's 1.5, 175, right? But if it starts crawling above 1 and doesn't reject from it, and it does so, let's say today and tomorrow, then they probably expect some dump into Wednesday, or vice versa. If this stays sub half a point like it is right now into Wednesday, that VIX expiration, then they probably expect the market to go up, like you said.
Okay.
But what we saw now is multiple indications of complacency and really high level of confidence that the market is either going sideways or up, but it's not going down under any circumstance. That's the way the market currently perceive the stuff. Now, low volatility is compressive, meaning that if there's complacency and low volatility, then all you can expect from the market is really small intraday moves, and the action is actually elsewhere in the single stocks. You would find, that's where you would make money right now.
That's where the dispersion is.
Yeah, and if you're trading these things intraday, so on average you'll take 15 points, 20 points maybe on the ES, and maybe 80 on the NQ. If you're doing the actual future directional. Whereas if you're selling options, then you have, more opportunity to capture some profits. But it's much harder to do to make money under these conditions when in this type of low volatility. So while you can trade theoretically without a stop because nothing happens, the upside is very limited.
All right, thanks. I'm going to cut it short here. I'm going to listen to Val Six.
Okay,
Thanks
my
for coming
friend.
on, and I'll bring you guys on. This is my crew, and I didn't get Punklandia on, but I'll get him on tomorrow. And Zelensky's got to go to a meeting anyway, so I'm not sure. He might get arrested for wearing his combat fatigues again. So we'll see.
Okay, man.
All
Thank you
right,
very much.
take care, everybody. Thanks.
Talk later. Bye.
Bye. All right, I'm ending. See you guys.